You've seen the headlines, a market getting whipsawed by almost 50% in less than a week, a story that stretches all the way from Shanghai to New York. And honestly, a regulatory reaction that makes you question the very structure of these markets. So let's dive right in and break down the anatomy of what just happened in silver. To really wrap your head around the sheer scale of this move, you have to start right here. It was just over a week ago that the market hit an all-time high, peaking at just over $120 an ounce.
But that peak didn't last long. What followed was an absolute collapse. The price just cratered, wiping out nearly half its value to bottom out at $63.98.
And get this, that entire roller coaster ride happened in just 5 trading sessions. So the big question is, how? What on earth happened? Well, in this breakdown, we're going to deconstruct the mechanics and look at the key data that drove this historic volatility. We'll trace it all the way from the initial catalyst to the shockwaves it sent across the entire market. So, when we trace this thing back to its source, the origin of all that extreme downward pressure, it doesn't point to the usual suspects like New York or London. No, the trail leads directly to the Asian markets, and specifically to the Shanghai exchange. And the data is really clear on this. This wasn't some broad-based, market-wide panic. The whole downward cascade was kicked off by a small but very heavily capitalized group. Our analysis points to one main trader, someone reportedly sitting on over $3 billion in profits from earlier market moves, who teamed up with about 6 other large speculators. And together, they launched a coordinated short-selling attack. Okay, to really grasp the impact of that selling, you have to look at it in the context of the COMEX futures market. So let's look at the open interest for the March contract. That's just the total number of outstanding contracts out there. And for that critical month, it represented potential claims on over 400 million ounces of silver. And this is where you can really see the massive leverage built into the system. You have those 400 million ounces in paper claims on one side, but they're backed by just over 100 million ounces of actual physical silver registered in the vaults and ready for delivery. That's a paper-to-physical ratio of about 4 to 1. And believe me, that is a critical structural piece of this whole puzzle. Now, this whole event also triggered some really different reactions from the regulators. And what you're about to see is a key difference in how things are handled in the East versus the West. Yeah, this timeline tells you everything you need to know. Look at this. The heavy selling starts late Wednesday in Shanghai. By Thursday, prices are hitting multi-week lows. But then, within 24 hours, Chinese regulators step in. They've already identified the traders who went over their position limits, and they forced them to close those positions out. Now, just contrast that with how things usually work in the US, where these kinds of investigations can literally take years to wrap up, not hours. If you're finding this kind of breakdown valuable, please do take a moment to like, share, and subscribe to the channel. That way you won't miss what's coming next. Okay, so let's talk about the ripple effects, because the impact of that concentrated selling was immediate, and you can absolutely measure it. The market just went into a state of historic volatility, and we saw this huge split between the paper price and what was happening in the physical retail market. I mean, just look at the sheer size of these daily price swings. It really drives home how volatile things got. We're talking a $45 range in a single day on Friday. And even on the quietest day of the week, there was still a $9 gap between the high and the low. And to really put that in perspective, you have to hear this quote. From 1984 to 2004, that's a 20-year span. It was rare to see even a $2 price swing in a single day. Think about that. The calmest day we just had saw a range almost 5 times bigger than that. This isn't just a blip. It's a fundamental change in how this market is behaving. And all that volatility on paper, it caused a major split in the physical market. You had major online dealers just reacting to all the uncertainty by blowing out their bid-ask spreads. Just look at this table. For something as common as a silver eagle, the spread, that's the difference between the buying and selling price, expanded to an incredible $23. To put it simply, dealers were buying from people at $10 under the spot price, and at the same time selling to people for $13 over it. That's a massive gap. Okay, so we've seen what happened. The crucial question now is, what's next? We need to take all this data and figure out the risks looking ahead. And we've boiled it down to 3 core risks you absolutely need to be watching. All right, risk number 1 is a technical one. All eyes are on the $70 price level. It's become this incredibly critical line of support. It was tested. It even broke for a little bit during the big sell-off. The bottom line is the market has to hold this level. If we see a sustained break below $70, that could be the signal for another major leg down. Risk number 2 is fundamental, and it all comes down to the COMEX delivery system. Keep an eye on February 27th. That's first notice day for the March contract. Basically, it's when things get real and buyers can start demanding physical delivery. Now, with 80,000 contracts still open, if a significant number of those holders decide they want the actual metal, it's going to put that 4-to-1 paper to physical ratio we talked about to the test. This is a huge potential catalyst.
And the third risk? It's all about psychology. It's behavioral. This market has been whipsawed by extreme emotions. From the FOMO, the fear of missing out, that pushed prices to insane highs, all the way to the pure panic selling that made it all come crashing down. A lot of new investors got caught in that swing, and what you're left with is a market that's just incredibly vulnerable to more of these wild, sentiment-driven shocks.
So, the data has laid out the cause and effect pretty clearly. We've walked through this historic sell-off, but the big question that everyone in the market is asking now is, was that it? Is this violent repricing over and are we settling into a new, stable range? Or was this just the warm-up act for the next major shock?